This time, it's different. Have you ever heard that before? Sir John Templeton, a visionary investment guru from the last decade, was fond of saying those words, "this time it's different," are the most dangerous words in investing. Why? Because classic investment principles don't change. And a classic investment principle that people ought to be thinking about these days is the fact that high levels of government debt, we have historically high levels of government debt, and economic stimulus that come from lower interest rates will cause inflation. Inflation at a time that countries around the world, Canada, United States, Europe, are already facing higher and stickier inflation than they'd actually like. So what does all that mean to you in your portfolio? Well, I'm going to come to that in a minute. But first, there's another very powerful investment principle at play there today. It's this: don't fight the Fed. The Federal Reserve in the United States, the central bank, the short term, the Fed, has made it clear they are going to continue to lower interest rates. And lower interest rates are stimulus to the economy. How is that? Well, think about it. Maybe you don't renovate your house if the cost to do that renovation is 7%. You might, though, if the cost is only 2%. Maybe you won't go get a new car lease if the leasing finance cost is 7.5%. You might get a new car lease, though, if the financing is only 1.5%. And a company may decide not to build a new plant and finance it if the financing cost is 6%, though they might decide to do it if the financing cost is only 3%. Lower interest rates stimulate demand in the economy. More demands is a good outlook for corporate profits, and higher corporate profits mean good for the stock market. All right, now let's bring it back to what this means to you in your portfolio. In my professional opinion, this is the time to be prudent, to be aware of the risks, and understand what you'll do if the market starts to go the other way. At the same time, however, it's not a time to be too defensive. It's not the time to run for the hills. The stock market could go much higher from here over the next year, maybe even longer. It is, however, time to review your overall asset mix holistically across all of your accounts and across multiple firms if you have your money invested at different investment firms. This is the time to review your allocation between risky investments and low-risk investments, making sure it's properly set up for the environment we have today. It's also the time to understand what the downside risk to your portfolio is when the feathers hit the fan. How much could your portfolio go down? So if you haven't reviewed your asset mix, if you haven't changed your asset mix in the last 6 months, it's time. But you don't have to do it alone. We have a resource called our Portfolio Risk Analysis Tool that will help you understand how much downside risk there is for your portfolio and even recommend some strategies to put your asset mix in the right place for the current environment. So please feel free, call us, get that resource, or call me. We're here to help. Be proactive, be prepared.